Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance. Here are your hosts, Lucas Muzialski and Leo Severino.
Hello everyone, and welcome to the second episode of the Wall Street Lab podcast. Last week we did an episode about M&A with Simon Hurst. It was a great conversation. If you haven't heard it yet, we highly recommend you go back and download it. This week we are focusing on the private equity side of the business with Oliver Schebela, another great guest who has extensive experience within the private equity field. Leo, why don't you tell us more about Oliver?
So Oliver started his career at Commerzbank, which is the second largest bank in Germany, and then moved on to Credit Suisse, where he worked as a product manager for alternative investments. So after that, he was the head of private equity at FERI Trust, and among other things, he was also our boss. He's now the head of private equity solutions at Bethmann Bank, one of the oldest private banks in Germany.
During our conversation with Oliver, we've touched on a variety of topics in the private equity space, such as the difference between direct and fund-of-fund investing, the pros and cons of working at a large firm versus boutiques. We also discussed the CFA designation and Oliver's experience in going through the exams. Before jumping into the interview, we would just like to ask you, if you enjoyed the show, please rate us on iTunes. It really helps us a lot in growing our audience. And now, without further ado, please enjoy our interview with Oliver Schebela.
And just one last thing before we move into the interview. The content you're about to hear is for information purposes only. It constitutes the opinions of individuals and therefore should not be treated as investment advice. Oliver, thank you very much for agreeing to talk with us. It's really an honor for us to be here. Actually, when we thought about this project, the first person that we had in mind was you. So it's actually
very honored. Thank you.
So it's actually a milestone for us to be able to be here. So for those that don't know you, if you're in let's say in a place where there are a lot of people that are not in finance, how do you describe what you do?
Well, basically, we are trying to look for investment opportunities in the area of private equity. And private equity is an area that is typically reserved for institutional clients. And what we do is we serve primarily very wealthy private clients, but still they are typically not able, because of the high minimum investment amounts that are required, to access these investments directly. So we try to look for ways and vehicles to provide our clients access to this interesting asset class. And maybe to get it a little bit more in perspective what private equity is, it's not too much different from any stocks that probably a lot of people have made an investment with already. The only difference is that these companies where you are participating in, they are not listed on a stock exchange. So they are not public, they are private. That explains part of the equation. And equity is obviously you're participating in the equity of these corporations. And another difference to public equity is with public equity, you very often pursue a buy and hold strategy. So you invest and you just look from the outside and hope that it develops in the right direction. With private equity, there's a special component included, which is an active support of the management of the companies you are investing in, with the idea to make these companies more valuable over time and to capture this value by exiting the companies in, let's say, 3 to 5 years' time. So that's basically the idea behind private equity, to invest in private companies for a limited number of years and to exit. And upon the exit, the idea is to capture a capital gain. And what we try to do, and what I specifically try to do, is to offer to our clients ways to enter this interesting universe of investments.
So you're not investing directly into the portfolio companies, you are investing into funds that invest in those companies, right?
Yes, that's correct. So as an investor, you have 3 ways to access private equity. One is directly purchasing companies. You need to have a very deep knowledge of which companies to buy and what to do with these companies. And obviously you need to have very large not only financial resources, but also management resources to support these companies. And obviously, there's not a lot of diversification coming with this approach. The second approach is that you do it the indirect way, and this is how most investors access this asset class. So on the indirect way, you have the opportunity to invest with so-called private equity firms that launch private equity funds every other couple of years, and they try to build portfolios of private companies. Typically 10 to 20 companies, sometimes up to 30 companies are forming these portfolios. So you have a layer of diversification included. That is the way how most institutional investors access the asset class. And there is a modification of that way. You can also invest in something that is called a fund of fund. So that is basically a fund that invests in other private equity funds. And through that way, you obviously have even more diversification, but obviously you have also another layer of fees, because there's not only a private equity firm involved that gets a management fee and then the performance fee, there is also the fund of fund manager that gets paid for his services. So these are the three basic ways how to access private equity: A, the direct investment; B, the fund investment; and C, the fund of fund investment. And what we do is offering our clients access to the B and C version, means funds or fund of funds.
Okay. Now let's go back a little bit in time. Imagine you're 17 years old and you're just leaving school. Were you always interested in finance? How did you actually get into finance?
Actually, at the age of 17, 18, I had no clue what to do. But most of my friends at school, they thought that either studying law or going to university for studying economics or management, that this is the option that gives you most flexibility later on. So I chose the way to study economics and business management, but I had not really an idea what that means and what I could do afterwards. But I was not doing it purely on the academic way. I was participating in a program that combined the academic world with the practical world, and I was working part-time in a bank. So I was studying for 4.5 years and in parallel working at a bank. So I got some insights into the finance industry, which helped a lot. But at the age of 17, 18, it was more random choice that I ended there. It could have been something else. And finally, I feel quite comfortable there, but it was not really planned like that. And it's asked a lot for if someone at the age of 18, 19 or 20 knows already what to do.
Yeah, I agree. I think this is the situation of most students. Even there are people that are 27 and still don't know what they want to do. And actually, that's one of the reasons why we started this. You touched on the study and work at the same time. And I think this is something specific to Germany, this apprenticeship some of the banks provide. And you don't see this in a lot of other countries. Can you talk about how important you think that is to someone just starting out, to have not only the theory in class, but also the practice?
I think it's quite unique what we have here in Germany, this apprenticeship program. I think it's very valuable if you provide young professionals that come out of school an opportunity to learn actually a job by combining going to school and learning it on a practical day. So it helps a lot. I mean, I remember having worked in a bank organization, you get to know a lot of different departments. You know how a bank functions. You know how the different departments work with each other. That is extremely helpful, and you notice it especially in the later phases of the university's degree, where you only learn theoretical methods and how to apply them to know how they can get used in the practical life. So I think this is a very valuable and a proven model that we have worked out here in Germany. And I don't know if it exists in other countries. I mean, in the US for sure, that concept is not known, but I'm not even sure how France or the UK handle it. They have a similar program, but not that I'm aware of.
Yeah, I think this speaks very much to the practical way that Germans think. They don't care much about what you have on a piece of paper, but they care about what you can actually do and how you can perform. So
yeah.
No, okay. So you spent 4 years in this apprenticeship program.
It was actually 2 years. 2 years apprenticeship program. And that's the typical time it takes. And after that, as the study program went 4.5 years, I spent another 2.5 years in various departments of the bank as you could call it a trainee. So I was further trained on the job, and I finally ended up working in the asset management department, which was again, more happening by accident. So I was there for 6 months. And I thought, oh, that's quite interesting. At that time, it was the topic of private equity first time came up in Germany. It was still pronounced a little bit different back then. Some call it private equity. So they knew it is something that came from the US, but they had no really clue what it means. But it was something that this department I was working in, they wanted to get a deeper knowledge in what is behind private equity. And I was the youngest professional there. I had basically no other duty, no other task. And this new topic came into this department. This department was called product development. So it's a little bit, not a little bit, it was actually very entrepreneurial. And you could think about new products, innovative approaches in asset management. And the topic of private equity, as nobody else wanted to do it, landed on my desk. So as another cause of accident, I came into this private equity topic. I've heard about it at university, but only from a practical point of view. And now they were asking me, think about ways how we could implement this in the bank, how we could make a product out of it. So this is how I actually came into that. And if I count it now, it's more than 20 years that I'm dealing with private equity.
So you were one of the early adopters of private equity in Germany. Now, after that, you moved to a different bank, right? Did you move?
I spent, let's say, 3 years at Commerzbank doing product development and asset management.
Okay.
At the beginning, more on the traditional side, so stock portfolios, bond portfolios, mixed portfolios, and with the idea of private equity being more in a conceptual phase. So Commerzbank was not really, well, private equity didn't exist there. You need a very special skill set to invest in private equity. And I noticed after, let's say, 1 year of project work on that topic that Commerzbank is probably not the right place to really gain practical experience in this asset class. So I actually, you're right, I moved to another bank who were looking for a product or project manager to look for interesting investment opportunities in the area of alternative investments, which included, besides hedge funds, also private equity. And this is how I gained my first practical experiences. Okay. And actually, it's quite funny, this program, which was set up in 2000, 2001. Mm-hmm. I started there in 2001. So I was there at the beginning of this program. And this program has now a 16-year history. And I've left Credit Suisse at that time.
Okay. This is one question I had is, how important do you think it is for a young professional like you were back then to have a big world-renowned bank like Credit Suisse in their resume in order to propel their career forward? Is that something that you would do again? Is that something that you would advise someone to do it if they were in the same situation?
For me, it was the right way. There are pros and cons. Having a name like Credit Suisse in your resume is always very helpful. But on the flip side, if you do it with smaller organizations, you very often have the opportunity to work with broader scope. Means in large organizations, you are often responsible for a very small fragment of the value creation chain, whereas in smaller organizations, because of lack of resources, you see more of the entire value chain. In the case of Credit Suisse, and in my case, it was extremely helpful to have this brand behind you, because in private equity, one of the key success factors is to get access to good managers. And access to managers often is a function of reputation and name. And having Credit Suisse on your business card was extremely helpful to get an entree with all the famous private equity funds. So if you write them with a Credit Suisse email address, it's much easier to get an appointment with them and a conversation about getting access to their funds than if you write to them from a source that is not so well known. So it depends on what you want to achieve. So I think, generally speaking, a very well-known and reputable firm is very helpful in your further career development. But that doesn't necessarily need to rule out smaller organizations, boutiques, for example. So if you want to get into private equity, for example, you could start applying directly with a private equity firm. So you do not need to gain the experience by working in a bank for a couple of years before, because there is a differentiating skill set if you want to do fund investments, like I do it now, or if you want to do direct investments. Because with direct investments, you can't learn to be an entrepreneur. being a good private equity investor means you have, for example, studied medicine and you're looking for interesting investment opportunities in the life science, in the biotech universe. There, your knowledge about this sector is extremely important, and the financial skill set that you need, the financial modeling, how you judge the perspective of or the potential of a business, is something that you learn on the job working for a private equity firm. So it really depends on what career path you want to follow. It can make sense to start directly working for a private equity firm, because the skill set that you earn being responsible for selecting funds is a different skill set than you need if you want to invest in companies and make judgment calls on the business model of these companies.
And I think this is probably a point that a lot of people misunderstand. If you say I work in private equity, it could be investing directly in private equity or investing in fund of funds.
Exactly.
Okay, so let's touch on your skill set. How do you differentiate between the good, the bad, and the mediocre?
How do you start is probably, because that's the easiest, you look at the past track record. There's this little disclaimer that is always below a financial product, that past performance is no indicator of future performance. That is obviously true, but in private equity you see that there is a high likelihood, if your last fund was in the top quartile or in the second quartile, that your next fund will also be an above average performing fund, and vice versa. If your last fund is in the third or the fourth quartile, the next fund also is most likely not a top performing fund. So that's typically the starting point. Today, I think the latest statistics I have seen is we have almost 6,000 private equity firms that are active worldwide. So that's typically how you start. You look at the past track record and just look at who is above the average. But that's a starting point, but obviously you need to make the call later on if a manager that has in the past delivered above average returns, is he capable of repeating that in the future? So you need to take a careful look at a variety of things. We describe it here internally. We look at 4 sectors that are starting all with a P. So you look at the people behind it, you look at the philosophy, you look at process, and you look at, as I said, the first point is the performance. So start maybe with the persons. You need to ask yourself if the people that were responsible for the track record in the past, are they still on board? Are they still the same people that are going forward will run the show? Are they still incentivized enough? Are they still hungry enough? That is a very key component. Has there been a lot of turnover in the team, for example, is an indicator that probably the performance of the past will not be repeatable in the future because it's an entirely new set of people. Then you want to look at the philosophy of how they invest. Do they invest in small cap, in mid cap, in large cap companies? In which sectors do they invest? How do they source deals? In which geographies are they focusing to find investments? And that translates also into the process. Like, how is the decision-making process in a company? Is it depending very much on one key person that is making the decisions, or is it an institutionalized process of how investment decisions and exit decisions are made? And it's really a puzzle that you are building, and it depends. I mean, if you look at a private equity firm for the first time, you say, well, it looks interesting, it's a good strategy, it's a nice story, typically encountering very good salespeople that are trying to sell that to you. So when you look at the first time, it's very difficult to make a judgment call on, is this a good or a bad firm? It only comes with experience. So you need to have very many of these kind of meetings to see how different private equity firms handle these 4 Ps. And just with experience over time, you will notice the differences, and will see what differentiates a good from a mediocre or a bad manager. And it all comes with experience. So I can only encourage, if you have the chance as a young professional to work in an environment where you have the possibility to participate in manager meetings, to do that and to gain as many experience and repetitions in these kind of meetings as possible, to really get to know what is the critical points to look at.
We actually had an interview with the head of hedge funds at FERI last week. And one of the things, we asked the same question, and what he said is sometimes when he goes to due diligence meetings, he asks to open the analysis spreadsheets, and he looks at when the spreadsheet was last opened. And if it's been 2 weeks, then it's usually not a good sign.
Yeah.
Are there little tactics that you use to make the managers feel uncomfortable so that they can get out of their comfort zone?
What you try to do in private equity, you try to scratch on the surface just to dig a little deeper. So private equity managers have their way of presenting their track record. And if you look at the statistics, they're always in top quartile. So it's mathematically not possible that every manager is top quartile. Otherwise, where are the other 75%? So it all depends on what kind of metrics you are applying to show in which quartile you are. So we are trying to dig deeper in and to really discuss the track record of the manager by looking at individual deals that they have done. And when you sit together with a manager and to discuss a deal, and you ask how have the earnings developed over the last quarter, how has leverage decreased or increased over the last 12 months, you try to ask a lot of detailed questions in there. You very often notice differences of how close a manager is with his company. They all say we are very active managers. We are proactively working with management. But when asking these kind of questions, you notice differences, that some are very much into the details. So they're responsible for 4 to 5 companies on average. So I would expect that a manager knows the details of the companies where he's invested in. And if he's uncomfortable and he's not able to give me the answers, or he has to look up the answers, that's for me an indication of how close and how hands-on this manager really is.
Okay, so can you elaborate on the difference between investing for institutional clients versus investing for high net worth individuals as you're doing here at Bethmann Bank?
I think for institutional clients, they purely look at the numbers, and it's typically almost free of emotions. A private investor, he's doing more, I wouldn't say any more emotional investment decision, but he looks at, do I like the people? Do I like the story? And if he likes it, he does the investment decision right away. Whereas an institution, they typically take months until they make an investment decision. In an institution, there are typically many boards that need to approve something, or committees that need to approve something. So the whole process of investing for institutions, it takes much longer. It is very formal. And with private clients, it's more an emotional decision. They need to like it. But if you look at the typical profile of our clients, these are former entrepreneurs. They know very well how it is to make business decisions, how to make a decision to make an investment, and they are aware of the risks that are associated with private equity. It's an entrepreneurial investment. You can lose basically with one company, you can lose all your money. That's why diversification is so important. And our clients are typically known to making these kind of decisions, and they are aware of the risks, but they are willing to take them because if you compare the returns that are achievable with private equity and you compare them with public equity, there is a lot of academic research show that there is a premium that you can earn with private equity, which is on average between 2 and 5% per annum between private and public equity. And if you want to gain this extra premium of return, you can gain that by accessing private equity, but it comes along with some sacrifices that you need to make. It's not a liquid investment, so the stock you can basically sell every day. With private equity, it's different. If you commit to a private equity fund, these funds have a maturity of 10 years. So you have to make a commitment at the beginning. You don't have to pay in all the money. So there's a difference between committing to a fund and when actually the cash flow or the cash is drawn from an investor. And typically it takes 5, 6, or sometimes 7 years until your entire commitment is drawn. And you typically get first proceeds back after 3, 4, 5 years. And after 10 years, ideally, the entire portfolio is liquidated and the investors have gotten back their money. So these are kind of peculiarities when you invest in private equity. it is something that you need to be aware of, that it's not a liquid asset. But if you're willing to sacrifice some of these points, you're able to catch this extra premium in returns, which is, I think, especially in this environment we are currently in, it's a quite attractive risk-reward proposition that private equity can offer. If you invest with the correct managers, obviously. If you invest with the wrong managers, it's also a quick way to destroy your wealth. But that's why you should have really a lot of experience when entering this asset class, or have an advisor that has this experience that can direct you towards the better funds.
So this 2 to 5% premium over public markets, is that attributable to the liquidity premium only, or part of that is also manager skill? And another follow-up question to that is, do you have to invest with the top quartile funds in order to be able to gather that 2 to 5% equity premium? Or if you invest in a second quartile fund, you're also able to receive that premium over time?
So let's start with the second part first. The studies I mentioned, they compare average returns. So the 2 to 5% premium gets even larger if you are able to not invest in the average private equity fund, but in the better private equity funds. And to what is this premium contributable? It's partly an illiquidity premium. It's partly a premium that is associated with the skill set of the manager, this active management component that is key for private equity. Private equity is not only giving a company money and let the management do with the company what they think is appropriate, but really guiding them, advising them, and strategically developing them to the next level. But it is, I think, necessary that this return premium exists. Otherwise, people wouldn't sacrifice the liquidity if it would return the same. So it's partly the illiquidity premium, and it's partly the skill set.
Okay, and given that private equity has been going through some changes over the last, let's say, 10, 15 years, you've seen the secondary market actually becoming very large, and limited partners being able to buy and sell shares in private equity funds. Do you see that liquidity premium is actually decreasing over time? And how do you see that affecting the private equity industry as a whole, if at all?
Let's maybe start with the evolution of private equity over time. If you look at the 1980s, like when the industry slowly started to develop, primarily in the US, what was the main value driver in a private equity deal? It was basically coming from leverage. So you were buying companies with sometimes 90-95%, or in some instances almost 100% debt. So there was not really much active management that was necessary to create stellar IRRs. It was just financial engineering, to put it that way. And it was possible at that time because there was not a lot of competition for deals. So there were a handful of private equity firms that were pursuing that business, and they didn't need to provide a lot of value add to deliver attractive returns. But the whole industry has really developed since then. And if you look at how a private equity firm today creates value for their investors, they are very much focusing on making the companies better companies, like improving their operations, improving their cost structures, strategically developing these companies to the next level. So today, when a private equity firm buys a company, they have analyzed typically very well what are the key levers that they need to work on to make the company more valuable. How can they increase revenues? How can they increase the earnings margin? Obviously, leverage still plays a role, but it's not the main criteria anymore. Another famous way, or very popular way these days, to make the companies more valuable is to pursue a buy and build strategy. And that's a very interesting one. You buy a company that is typically the leader or the market leader in their specific market. Let's say the German market, the market leader in Germany for producing some goods. And based on this investment, you do some add-on acquisitions to broaden the product spectrum, and also to expand into other countries, and to create bigger companies that are, for the new buyer, have a different risk profile. For example, you buy a company today for 8 times the operational earnings of the company, and by growing the company into a different size category through this buy and build strategy, and by diversifying their business, you're able to sell them for 10 times the earnings. So if you're able to create these kind of expansion, of these kind of growth opportunities, that's the third layer of how you can improve, how you can make the companies more valuable. So leverage effect is one, operational improvements is the other one, and also making use of multiplying or arbitraging the multiple. And if you look at the spectrum of how private equity firms today create value, it's primarily the operational improvements, and the equity arbitrage and leverage plays a minor role in delivering these returns. But it still only works with leverage. But the whole industry has really developed, and it's a very professional industry these days, and the companies really try to make the companies on a sustainable level better companies, more valuable companies, by making them, by upgrading management processes and the entire value chain. And if the illiquidity premium has decreased, maybe that can be because of the entrance of secondary funds. But to be honest, I haven't seen a research on that lately to quantify the effect. But I could assume that this is indeed the case.
Let's switch gears and talk about some advice that you could give to young professionals starting out in private equity. If you had a 20-year-old cousin or a son that said, Oliver, I'd like to start working for a private equity fund of fund, what are things that you would tell him to do?
I think starting on the indirect side, on the fund selection side, doing it for a couple of years is the ideal way to get into private equity, also into direct investing. The only thing you need to make sure is that you don't spend too long on the indirect side, because then you will have gained a too high seniority, and the step on the indirect side you will need to make a step back again because you are junior on the indirect side, on the direct side, and that also typically comes with a lower salary, which is also a tough part if you have once gained a certain level to adjust yourself again. So I think it's valuable to get insight into private equity by starting on the fund of fund side, let's put it that way, or on the fund selection side. And then after a couple of years, after you got to know the universe very well, and what are the good players, what are the key success factors, because if you want to start working for a private equity firm right from the beginning, as I said, you typically don't know what differentiates the good from the bad. But if you have gained the experience of working on the fund of fund side or on the indirect side for a couple of years, you know that very well, and you know what is necessary to look at before choosing a potential new employer for yourself. But that is not the question you asked. I'm totally aware of that. If you want to gain experience on the indirect side, on the fund of fund side, I would advise, first of all, studying on the economic side. The management side is helpful to get into that. Gaining experience in the financial sector, working in a bank, working in an insurance company is something that helps. And I think you can, without a lot of prior working experience, you can basically, after your master's degree, start right away in a role that is involved in fund selection. If it's not the beginning on the private equity side, you can start with a traditional fund selection on bonds and equities, because the skill set that is necessary is somewhat similar. And you guys, you have experienced it. You started right after university in a role like that. So there is not a lot that I can give in advice that you say you need to make this and that step before you can do this. You can actually start right away. Obviously, there are not too many companies that provide these services here in Germany. So it's not so easy to get into it, but I think you guys made exactly the right approach. During your studies program, you were working student, and you gained through that a lot of experience there. And you had some colleagues that were hopefully able to guide you a little bit and to take you to manager meetings, so you got into it. And I'm totally aware that there are not too many firms, but there are, for example, family offices that invest in private equity. There are insurance companies that invest in private equity. There are pension funds that invest in private equity. This is especially the pension fund system in Germany gets more and more important. So they see the benefit that private equity can bring in the overall portfolio. So they are building teams there, and I think they are increasing opportunities these days to get access and to get a first professional step into the private equity world on the indirect side.
I actually need to confess something to you. This is actually a career advice session disguised as an interview. So we're actually learning as we go here. The next question I have is, whenever you're interviewing people for a role at the companies that you've worked for so far, what are some things that you watch out for, and what are some questions that you ask in order to gauge whether or not the person is the right fit for you?
What I would like to see is that a young professional that wants to work in that space is asking the right questions when you give them, for example, a case study. So that is something that I would like to see, that a person uses his brain and asks the right questions and draws conclusions by looking at a case or at numbers. These can absolutely be the wrong conclusions that they draw, but I would like them to think about it and to share their thoughts and how they would tackle a problem, how they would solve a problem. And if I see that the people or the person is really interested in that topic and is asking clever questions, this is for me a strong indicator that this person could be developed into that space. Obviously, he's missing the practical private equity experience, but that is something that comes over time with experience. The precondition is curiosity and interest to learn, and you notice that when you look at the kind of questions that people ask.
The first interview we gave, and we asked this question to Simon Hurst, and his answer was, he looks down under the table and sees if the shoes are shiny. Do you do anything similar to that? Do you try to have a sense of how the person actually behaves in their personal life based on how they look, or is that something that's not of interest to you at all?
It can be of interest, but it's often not a good indicator of the person's capabilities, at least from my experience. So I try not to focus on these kind of things. I know what this person probably wanted to convey with his answer, but it's not something that I have taken a close look at, to be honest. I just want to see that the person is curious. Obviously, the person needs to be at the same. There need to be a sympathy level. You need to want to work with that person because you're in the office, spend a lot of time together. So the chemistry should work. But in first instance, I would like to see that the person is capable of fulfilling the job. And sometimes our job requires investigative skill sets. So, for example, if a manager presents to you, it looks always great, shiny, and as I said, they're all first quartile performers. So our job is to really scratch there and try to find inconsistencies or find out where the story is probably not correct. So people that is too passive and just accepts everything that you tell to him is probably not the right candidate for investing in private equity, because you need to be critical. You need to ask critical questions and try, as you were also indicating, bring the manager away from his comfort zone and see if the whole picture is really round. And you will most likely, if we dig a little bit deeper into the due diligence process, you need to speak with very many people from an organization to see if the answers that you are getting are consistent. And you should try to speak with different levels, because the top level, the partner level, is typically very well trained for these kind of sessions. But the younger professionals, you get often more honest answers or less polished answers, to put it that way. And there needs to be this natural curiosity on our side to speak with these people, to find out if the story that is presented to you is really something that is not only a story, but is really lived in practical life. And for this job, there needs to be the interest really to look at details, to question things, and to dig deeper into the topic.
Okay, you are also a CFA charter holder, right?
Right.
So can you talk to us a little bit about how you decided to study for the exams?
How I decided. A friend of Commerzbank said that he's going to study for the CFA. And I said, what is that? And he explained that to me, and I said, I could do that. I just finished university and I have nothing else to do. Why not joining that? So I was pulled into it. I didn't know how much work it is. I regretted it when I was preparing for the first level of that exam, because it was a lot of studying and a lot of learning by heart. So when I conducted level 1, I really asked myself, why am I doing this again? And with level 2, it got already a little bit better, but actually only in level 3 I noticed that the different categories that you have learned so far, how they fit together, that for analyzing a particular financial problem, you have to draw this, that, and that lever in order to solve the problem. So I really can encourage young professionals to do the CFA program, but you need to live through it to the third level, because only then I experienced that it made sense to me what I learned before, because level 1 and level 2 is basically the preparation for what happens then in level 3. So in hindsight, I enjoyed it, although the 2 months prior to the exam were always a little bit challenging, because the exam at that time was always in the summertime. So I was regretting that April and May were basically not existing for me on a social life basis. But it's only 3 years. That's a good thing.
Only.
Only.
So do you think it was valuable to you, not only from a personal perspective, from the knowledge that you acquired, but do you think that employers in Germany saw you being a CFA charter holder as something valuable?
Do you think if it brought me more money?
If you can answer that question too.
I will share with you, when I told my boss at Credit Suisse that I passed the third level of CFA, he was very happy with me, but he said, what is it exactly? So you can imagine already that it probably didn't help me earn more money. But I have to say, it really depends on where you work. For example, if you work in the asset management business, I think there it is important that you have it. It's in some instances even a requirement to get a job, or at least when you get this job that you sign up for that program. If you're working, for example, in private banking, there the CFA is not necessarily required. And it really depends. And when I did that program, it was I started, I think, in the year 2000, and I finished in 2002. So at that time, the CFA program was not so well known in Germany. So today we have 2016. So I think it's much more known these days, and it's much more valued these days than it was when I did that program. But I did it I did it in first instance for my personal development. I'm not sure if it brought me into any particular job. I think there were always other reasons why I entered these jobs. But I would encourage people to do it for their personal development and not necessarily for monetary reasons.
For someone that is thinking about studying for the CFA exams, and you obviously passed all 3 exams, what are some of the tactical ideas that you had at the time? How did you organize your study schedule? Do you have any recommendation on how should you study? How long should you prepare? Should you take one day off a week? How did you actually prepare for the exams, if you still remember?
I remember one thing which I want to share at the very beginning. If you're sitting in this exam, and most of it is multiple choice, at least in level 1 and level 2, my personal advice is, if you don't know the answer, check B. It helped me to pass the first level. No, but seriously speaking, there's a lot of literature that is given to you as a recommendation to read. To be honest, I did not read them, but I was working with there are a lot of summaries, scripts. So I think they are perfectly fine to prepare for the exam. I think you should take 1.5 to 2 months before. You should really intensively start studying for it. At least that was my experience. Maybe I'm a little bit slower. 1 month is also fine, but it took me 2 months to properly prepare for the CFA. And my advice is really to do a lot of these sample exams or prior exams, because it's one thing to learn the topics and to understand the topics, but you need to be familiar with how the topics are examined, like how are the questions asked and how do you answer them, because it's really 2 pairs of shoes, understanding the topic and being able to pass an exam. What they ask is not rocket science, but it's basically you have very limited time to answer the questions, and the exams are often not designed that you really have enough time to answer all the questions, and you don't need to pass. But it is critical when you see the question that you're not surprised of how they are asked, and you should know the form of how they are asked, and speed is critical in being successful in passing these exams. So prepare a lot. That is my personal advice. Prepare a lot with the sample exams and start early enough with them, then you should do fine.
Okay, that's really good advice. Now let's jump to the last.
Are you doing the CFA?
I've done them already.
You've done
actually,
them.
Yeah. And this is probably a topic that we can devote one full episode to, some questions and answers, but that's for another day.
Yeah.
So the last part of the interview, we want to ask you very quick questions. The questions are quick, but the answers can be as long as you like. If you could outsource a daily activity, what would it be and why?
Administration. No, that was probably a bit too short. Working in a bank, the whole financial industry is very regulated these days, and especially if you are dealing with private investors, they need to have a certain level of protection, and that's why this regulation is very important. Obviously, it's not the most fun part of my job. I like to analyze managers, to meet managers and interview managers, and to learn about their strategy and how they do deals and what kind of stuff they do in the companies they invest in. That is the most fun part. But obviously, we need to put this in the bank in a framework that we need to make sure that all boxes are checked, that we are not taking any undue risks, that our investors are properly protected and informed. In some instances, the administrative work is quite time consuming, and this is, as I said, not the most fun part, but it's necessary. But if you give me the option to outsource something, this would probably be it.
Okay. Do you have any role models? Anyone that you look up to, either in your personal or professional life?
Well, in the professional life, I don't have anyone particular in mind. Obviously, being an interested person in sports, there are a lot of characters there that I admire and that I look up to. Especially, I'm a big fan of American football. I follow the NFL a lot, and my heroes there are the 2 famous quarterbacks from my favorite NFL team, the Denver Broncos, like John Elway and Peyton Manning, who has very recently won the Super Bowl with my team. So these would be probably the people I look up to.
I bet you don't have a lot of people here in Germany with whom you can share your passion for American football.
No, not too many. There are a few, and I'm happy for the few that I can share my emotions with on Monday mornings after I spend this Sunday night of watching these games. But I really love this sport, and it is one of the things that I took away from my semester in the US, that I finally understood how this game works. And once you got into it, it's fascinating.
A follow-up question. Have you ever had a mentor, or if you didn't, do you think there is value in having a mentor?
There is definitely a lot of value in having that. And I had the luck that very early on in my career, I had someone that that was mentoring me. My first boss, actually, a lady. I was her first hire when she got into that role, and she helped me a lot getting into very interesting projects at Commerzbank. And I think this is extremely valuable for a young professional, because you are in an organization that you don't know how it functions, and some guidance is very helpful. And being able to support you and open you some doors is something that is extremely valuable. And if someone is lucky enough to have a mentor, congratulations.
If you had the chance to spend 5 minutes one-on-one with anyone, dead or alive, who would it be, and what questions would you ask?
I would probably like to stay with Peyton Manning. But what questions I would ask him, I would need to think before, because if I have 5 minutes, I can't ask too many questions. So I should better think about the right questions before.
Okay. No, that's totally fine. You can think about the questions and tell us afterwards. Do you have any favorite books?
Yes, I have some favorite books. However, I have to say that I very often have only time in my holidays to really read. All the other time, if I read something, it's very often related to my professional work, a lot of research that I read or should read. But there are a few books that really fascinated me, and one particular that comes to my mind. I read that book, I would say, around about 2 years after the global financial crisis broke out. The book is called Too Big to Fail, and it is a very thick book. I'm typically a very slow reader, I have to say, and it takes very long for me to finish a book. But this book really fascinated me, and it didn't take very long to get through it, because when I was reading it, I had really the impression you were sitting on the shoulder of all the characters that were playing in there. You knew the names, you knew, obviously, by following what happened during the global financial crisis, like the collapse of various banks, the rescue programs that were knit in a very hectic and tight time frame. And when you read that book, you really had the impression that the author was following these scenes live by sitting in the rooms where the decisions were made. And it was written so interestingly, so fascinating, that even if it is already a couple of years back that I read it, I still think very highly of it.
Okay. We can only give you one piece of advice. If you don't have time to read, you can listen to audiobooks.
Yes.
Or podcasts, of course.
Podcasts, yes. That advice I had taken already, and on my iPhone are a few of these channels already.
Okay, good. Everyone has things that they want to improve upon in their either personal or professional lives. Is there something that you're working on right now? Something that you would like to improve upon, that you would like to share?
I very often have the impression that the day has not enough hours. So I should probably be more organized and more process-oriented in my work. So this is something I constantly try to improve.
Well, Oliver, thank you very much again for donating the time to us.
It was my pleasure. Thank you very much.
I want to acknowledge the fact that you are someone that gives your full attention once you're working on something, and I could experience it firsthand when I first started at FERI and I asked for an introduction to the company. You spent 1 hour one-on-one. The head of private equity spent 1 hour with a working student one-on-one explaining what the company does, and I want to acknowledge the fact that you're someone that gives your full attention to someone. You don't look at your phone. You're fully immersed, and I think that's probably one of the reasons why you are who you are and you got to where you got. So thank you, and
thank you.
Let's definitely keep in touch.
Absolutely. It was my pleasure.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.